If you are making the same money in 2026 that you made in 2025 and nothing about how you're earning it, keeping it, or using it changes, it is not stability. It is stagnation. And the IRS absolutely loves you for it. So does the government. Because when nothing changes, they already know exactly how much they're getting from you year after year. And spoiler alert, it's typically not a small amount. Welcome back to Spicy Takes and Tax Breaks, where we mix strategy, sarcasm, and the stuff the IRS really wishes I would stop saying out loud. I'm Aubree Denekamp, your tax strategist, numbers therapist, and the mama who will lovingly remind you day after day that your life choices do have tax consequences. And this is our first episode of 2026, which means today is not going to be your regular 2026 motivation resolutions chat. We're not go through vision boards today, manifestation journals, or this is my year type of energy. Today is something about much less sexy IRS stuff, but way, way more powerful. These are systems you can put in place that can save you so much money. Because if your plan for 2026 is just to make more money, I need you to hear me so clearly when I say this. It is not a strategy. It is a wish, and yes, it can be done, but wishes are so damn expensive. So let me start with something that makes people usually really irritated or uncomfortable when I talk to them about. Most people don't have an income problem to begin with. They typically have a structure problem that isn't being addressed. They have a problem that needs to be looked at of how they're set up, how they're spending the money, and what they're actually claiming as income and what kind of income. So I want you to picture this. Let's say you're making $180,000, then $220,000, then $300,000. And somehow you're still feeling more stressed, not less stress. You're feeling more pressure, maybe even less profits on top of it, but definitely a bigger tax bill, more anxiety every time April comes or March, whenever that looks like for you. And it's because income alone is not what you're creating your wealth with. Income without intention creates so much chaos, whether that is within a business, a W-2, a household. And the tax system in this country doesn't reward that effort. It doesn't reward your hustle here. It does not reward your long hours, your time away from your family. But there are several things it is going to reward. And I want you to think about that this year. It does reward ownership. It does reward planning. It rewards the people who decide ahead of time where their money is going to go and how they're going to utilize it. If your only goal is to continue making more money, you are going to continue spending more money on tax. You're feeding that bigger tax monster year after year and paying what you don't have to. So let's talk about what the IRS actually cares about here. Because once you understand this, the game really changes and kind of what you can look at changes. There are three things really that the tax code consistently is going to reward. One is going to be ownership, like we talked about. This would be owning a business, real estate, intellectual property, content, assets. Employees get taxed first in this situation. Owners are kind of shifting what is actually going to be taxable from what they're making and what is going to be an expenditure. It's not a loophole. It's literally how the system was built. Number two is going to be the structure. How you're set up so much matters here. Are you a sole prop when you shouldn't be? Are you an S corp with no payroll or a non-profitable S corp maybe? Are you paying yourself whatever is left and calling it a plan? I don't know. I see that all the time. I think people are like, hey, I need to make X as a W-2 to support my family and my lifestyle, but they're missing what is the actual tax strategy behind that? Where are you actually being double taxed versus saving the money? Two people can truly make the same $250,000 and one can legally pay 6 figures less in tax on it. Same exact income, just a different structure of how it's running through. The third is going to be timing. It's when the income is actually hitting, when the expenses or deductions are recognized, when your investments are being made and pulled from. Taxes aren't just about what you do and how much you make, but it's about when you're making it, when you're spending it. So it's something to consider here, especially as we're getting into the new year. This is why I try so hard with my clients to say December panic is not the way to go. They do still happen, but write-offs aren't tricks. They're consequences of decisions made in earlier months. That's why 2026 needs to be all about planning if that hasn't already been a structure in prior years. So I'll give you kind of an example here. I'm going to tell you about two of my clients. There are two different people, two different business owners, completely different industries, but we're going to talk about the same calendar here. Client A had what everyone would call a great year. Revenue was just over $310,000. They were second year in business. On paper, they were so excited. It was such a flex for them. They're a single member LLC. There's no payroll, no retirement strategy, no benefits, no proactive planning. The money came in, expenses were going out, and whatever was left was their income. All year long, that felt really fine. Cash was moving. They were able to pay their mortgage. They were able to put their kids into school. They were doing all the things they thought they should. The bills were paid. Life looked good. But when it came to tax season, and suddenly that $310,000 felt really unimpressive to my client. Because once you add on the self-employment tax, federal income tax, state exposure, where all of those are stacked on top of each other, the tax bill was pretty darn aggressive. It wasn't something they would have liked. It's not something I would have liked. I would have loved to have some planning time with them on that. But it's uncomfortable. It's completely avoidable as well, though. Not because they did something wrong or were not compliant, but they didn't do anything intentional and try to plan around that. We'll go to client B, same type of situation. Client B actually made less money, about $260,000 in profits. So already if you're looking at income, you'd assume they were behind compared to the $310,000. But client B is structured as an S corp. So they paid themselves a reasonable salary. They were also able to do employee and employer contributions for their retirement. We had an accountable plan to reimburse them for their personal expenses, their home, all of those things. And they timed the income and expenses with purpose, making sure that we were doing everything compliant, nothing aggressive, shady, anything that's going to be a red flag. It's just strategic. Same economy, same year, same tax code. But when we ran the numbers, client B was the one who made significantly less, almost $60,000 less in profit, but they had way less tax, way more control, way less stress on their end. They were able to use the money that they would have otherwise had to pay in taxes and actually reinvest it into their company. And in future years, hopefully continue to invest into their retirement. So this is where people get a lot mad, not typically at me, but at the fact that no one ever explained this to them before. We were told growing up, we have to work hard. We have to hustle. We were told to grow up. We want to grow our bank accounts, our savings. And we were told to grind until somehow we were able to retire and be okay. But no one ever sat us down and said, hey, making more money without changing how it's structured is volunteering to pay more tax. Not even just more tax on the money you're making, but a higher percentage as well, which is huge when we're looking at these big dollar values. So this is the part of the episode where I want you guys to really pay attention. Stop folding laundry, stop scrolling or half listening if you're even listening at all, but just listen closely. If you're have availability, grab an app or a pen to write some of this down, please do, because I want you to make your plan around taxes starting now. What I'm walking through is 5 warning signs I see every single year when I meet with clients for the first time and someone ends up shocked or frustrated and they're asking me, how did I get here? How do I owe this much? How did I not pay this much in taxes already? And if one of those applies to you, this episode alone could save you thousands. So red flag number 1 is going to be that you don't even know what tax bracket you're in. Not your tax bracket, not what Google told you, not what you think you're paying based on your last 1040. I'm talking about the actual percentage of your income that disappears before it's ever going into your savings. If I asked you that right now, what percentage of your income went to tax last year? Would you know the answer? If you paused it all, you're operating blindly. Because if you don't know what that real number is, you can't plan, you can't adjust, you can't save for it, and you definitely can't strategize to optimize against the liability. Another big red flag I see is if you're still filing as a Schedule C and profiting over $50,000. I know it seems simple and familiar. People talk about the S Corp all the time, but simple does not mean smart here. A Schedule C making $50,000 consistently year after year in profit is not streamlined. It is very exposed to that self-employment tax of 15.3%. It's a huge number. That income level, you're paying more self-employment tax than you need to, almost even more probably than you're paying in other taxes. And you're giving up control that you should have already had and been able to budget for and strategize around. If the only time you hear from your CPA is when your return is due, maybe March or April, maybe when you're getting ready to file for your extension, not a strategy. That is data entry with a deadline. That's it. Planning doesn't happen during tax season. It really is happening the prior year. Tax season is where that outcome is revealed, whether that is getting a refund back or owing a lot more money. Basically, all you're doing is filing that and getting squared up at that time. There's a huge, huge difference if you're not being advised and just having paperwork pushed or processed. Red flag number 4 is going to be quarterly payments. Most people have no idea what they're doing for quarterlies or avoid it altogether. If quarterlies feel like a surprise every single year or quarter, that is a system failure. This is something we should have mapped out when we're filing your prior year taxes. Quarterly payments should not feel like a jump scare, ever. They should be expected, they should be planned, accounted for, and paid. And when you're panicking at quarterlies, it usually means that there is no forecasting being done. You don't have financial statements that you trust. There isn't any sort of withholding strategy or why you're paying it. There's no clarity around it. And that stress is completely optional. It does not have to happen. Red flag number 5 is going to be that more money, better money. I hear that all the time, and I do love that strategy. More money is always fun to play with. But if the only goal you have in mind for 2026 is to make more without changing how you're making it, how that income is classified, protected, deployed, spent, you're looking at a huger tax bill year after year. More pressure, more burnout. Better money is intentional. It has a job. It is there to help support your long-term goals. It builds wealth. It's not supposed to build anxiety in a bigger tax bill. And if no one has helped you think about money this way before, this is exactly why you're here and why you need to be advising with someone who is going to help you walk through this process. What does right now look like? Are you trying to buy a home, or can you whittle away your income? Do you need to have any of that buying power? Are you looking at retiring anytime soon or in a longer term sense? If this section hits you at all and you're like, hey, I don't have that, this is for you. Good. It means that you are paying attention here and you can create 2026 in a different manner, because it is just the beginning of what we're going to be doing here in 2026. So I'll paint a different picture for you here, because once you see it, you just really, it's hard to go back. At least for me, it was. So it doesn't have to look chaotic. And what that can look like is non-frantic, not relying on those last minute scrambles or tax season prayers. Hopefully the IRS doesn't come knocking. It's actually intentional and controlled. It starts with 3 things, and you can do all 3 of them starting this month. Step 1 is going to be know your number. I don't mean your revenue goal. I mean your actual number. How much did you actually keep last year? What was your profits? What were your distributions? How much did you make in revenue? But how much actually hit your taxable revenue? What stayed? If you don't know that number yet, your only job this week is to find it, whether that is doing it yourself, hiring a bookkeeper, getting someone to get everything cleaned up, because once you know that number, you are going to stop guessing and start deciding on how that looks for you. Another one is going to be knowing your exposure. This is step 2. This is where people get really uncomfortable, but it's where you become the most powerful. You got to ask yourself, if I make the same income this year as last year, what portion of this is automatically exposed to tax? Is it 25%? Is it 35%? Is it 65%? What if that income is going to be flexible? What income is locked in, such as a W-2? What income could be repositioned with a new structure? Exposure is not something I want you guys to fear here. This is where it gets so fun, and it's something that you get to manage as you start putting it in place. Once you see it clearly and how much room you actually have to play with under that structure, it's fun. And on to step 3, this is the sexy part, your levers. These are the things that you can pull before December 31st. This is going to be your entity structure, payroll strategy, any sort of benefit, retirement contributions, paying expenses in advance or delaying them, benefit layering, any of that. They're not hacks, they're actually systems that are put in place by the IRS for you to use. And these systems are what separate people who hope for refunds from the people who actually are able to plan for their outcomes. So doing it right in 2026 means your write-ups aren't panic purchases. They're baked in and planned. Retirement is not an afterthought. Your expenses are not accidental, and your money already knows where it's going before it comes into your bank account. That is going to be the shift from 2026 to prior years. You're going to stop reacting and you're going to start operating. Let me be very, very clear about this. January is not slow tax season. January is actually one of the most powerful tax months you can have. Why that is, similar to any other thing, getting a new workout goal for the new year, coming up with a budgetary plan, how you're going to stay more organized. This is when strategy is actually coming together. Strategy is typically the cheapest during January, February months. Also, flexibility is the highest and options are the widest. You have the whole entire year to play with. So every decision that you're making right now through the end of the year is going to echo how the rest of your tax bill looks. January is where you get to decide whether 2026 feels lighter, more control in your hands, whether it's running smoother, building something real, or compliance for the first time ever. Whether it feels exactly like last year, just with a higher income and a bigger bill, or control in your hands. This is what I want you to kind of start changing your mindset to. And if you're listening to this right now, you're early, you're doing exactly what you should be doing, which means you're gonna do great if you keep listening. So here's the deal. If you made the same money in 2025, but it didn't change your life, it didn't help advance, it's not a mindset problem. There is a strategy gap somewhere in your filings or what your strategy actually of making money throughout the year is. So if you want my 2026 tax strategy framework, the exact checklist I use with my 6 and 7 figure clients, DM me the word queen and we'll shoot that over to you. So before you want to start guessing and start operating like an actual owner, the link to apply for 2026 strategy call is also in the show notes. More money with strategy is more stress and a way bigger tax bill. We are absolutely not doing this for you if you're working with us. This is Spicy Takes and Tax Breaks. I'm Aubree, the write-off queen, and I look forward to seeing you guys next week.